Property prices are predicted to boom. Let's have a look. Good morning, everyone. Florian.Heise here, and welcome to another episode of HeiseSays. I have my morning stein of coffee, and I thought we'd go through this article from Yahoo Finance, shared by a viewer in a comment on a recent video. It's to do with property prices shooting up after this global pandemic, guys. Now, if you've been living under a rock and you don't realize that housing property prices haven't shot up in Australia since 2006, it's funny, property has gone up significantly while our per capita GDP growth has been below trend since the GFC. It's almost as if something is stimulating that market. You've got to remember, we're a property obsessed nation, and I think that's fair to say. No one would be able to make a strong argument against that. Sure, we love the footy. Sure, Australians love a good beer, but we're property obsessed. Every show on television is about property. Every man and his dog is making their fortune in property. So everyone is concerned and worried what's going to happen. We're all tied up. A big portion of the wealth of our civilization is in property that we own, property that we've invested in, property that we have in our super funds. So when people are claiming that property will shoot up after this pandemic, I don't understand how. But then again, I'm realizing we are living in an irrational clown world. So rational understanding isn't as important anymore. So let's have a look through this and ask ourselves a few questions. Property price growth is expected to skyrocket following the illness crisis if past economic recoveries are anything to go by. Experts are forecasting house values to shoot up at the end of the pandemic, which is consistent with what tends to happen after economic shocks. So they're expecting housing prices to shoot up. According to Propertyology Managing Director Simon Presley, real estate prices have traditionally led economic recoveries in past crises. Residential real estate is the one thing which is common to 25.5 million Australians. After all, shelter is an essential commodity. The last time Australia had a recession was 29 years ago, and real estate led the rebound out of the downturn back then. Over those 3 years, ending 1993, 8 out of 8 capital cities produced property price growth of between 2% and 27% in Perth, he said, adding that the performance of regional property markets was strong, if not stronger, than capital cities. Remember when we were always told past performance isn't an indication of future growth or future performance? Do they still say that anymore? Guys, do they still say that anymore? But then again, past failure isn't an indication of future failure. Although I think we could learn from both. So here we go. Safe as houses, the 91 to 93 recession. I mean, there you go. Look at the median house price change. But what was the change in house prices before then? What happened to house prices in the 80s? Why isn't that discussed? And I think I'll know why. We'll have a look at that in a moment. Australia was the only country to avoid a recession when the global financial crisis hit the rest of the world between 2008 and 2010. Property prices in all capital cities rose, as did regions such as Ballarat, Bendigo, Lonnie, and Armidale. There we go. Well, you only got one place in WA going down. Everything else is going up during the GFC. The nation's housing market will cop a hit from the illness pandemic, but it won't last long, says hotspotting.com.au director Terry Ryder. I expect a short-term hit, which will vary from location to location, then a strong rebound, he said. Then a strong rebound. Could this be fueled by the insanely low cash rate? It's cheaper to get money than ever before. And they're comparing this to the 93 recession, the GFC. This is a much greater scale than that. This is like the Great Depression with regards to unemployment. And I know there are a lot of things different from now to the Great Depression, but there's some things I want to talk about and look at. And they're completely ignoring the fact that we've got all this money printing happening. and with the particular effect that we're going to have. And I'll bring up this quote here. The Cantillon effect refers to the change in relative prices resulting from a change in money supply. Now, with our obsession with property, with more money entering the market, with everyone entering property, that is a way that additional money supply enters the market. By borrowing money, you are creating money. It's once you get your head around it, you understand how it all works. It's not the old-fashioned, oh, you're just borrowing money from other savers. No, you're not. The money is created when you borrow it. So that is one of the arguments I would say we are seeing a bubble in our property prices. According to AMP Capital Chief Economist Shane Oliver, the property upswing will depend on several factors, including how far house values fall, as well as how long the national shutdown will last. I suspect that if the shutdown ends by mid-year, resulting in minimal second-round damage to the economy, unemployment contained to around 10%, and prices falling, say, 5 to 10%, then all the stimulus should see a pretty decent bounce in prices into next year of around 10% or so, he told Yahoo Finance. But if the shutdown goes for much longer, if unemployment rises to, say, 15% and prices fall to 20%, the recovery may be much slower. So apparently there's an upside to this crisis. According to Presley, no two crises are the same. But this pandemic actually has some good things going for it. The cause for this crisis is known and has a time frame. There is global coordination in dealing with the crisis, and many countries have learned their lessons from the GFC. Have we learned our lesson from the GFC? Well, yes, we have. Bend the knee to China. Australia has learned the lesson, hasn't it? On top of that, the property market has been largely suppressed in the 2 years leading up to the COVID-19 and government stimulus package. Will stem a spike in distressed property sales. Okay. In the coming months, as Australia gains confidence that we are getting on top of this germ, the attention of all levels of government will be to turn to policy to crank the economy back up. And will they just do it in housing? Will they create more issues from that? So what are the investment opportunities? According to Ryder, investors who are able to think and act independently of the herd will fare well. The herd will retreat and there will be relatively little competition from other buyers, he told Yahoo Finance. The fundamentals still apply. So target locations with diverse economies, growing populations, and affordable real estate. Okay. So apparently the property market's been suppressed in the last 2 years. Let's have a look at some other things. Let's look at this article from the Global Management School and just discussing the Great Depression. This, I know it's from 2010, but it's still useful. A decade before the 1929 stock market crash, there was a booming real estate market in New York that Assistant Professor Ann Sherbner says resembles the housing bubble of the 1990s and 2000s. In a recent radio interview, Sherbner discussed an index of home prices in Manhattan between 1920 and 39, and she and Associate Professor Tim Nichols of the Harvard Business School collected by hand from the Manhattan Public Library archives. This data set is informative because the housing market in Manhattan represents 5 to 10% of all the U.S. real estate wealth at that time. Now, I know this is the U.S., I know this is Manhattan, but I think there's lessons to be learned here that we need to consider when we're seeing all these predictions in the media about Australian property, because we have a bubble. Manhattan property, I think, is, well, it's some of the most sought-after property in America. So what happens there is important. According to Sherbner and Nicholas's working paper, Real Estate Prices During the Great Depression, the price for a typical Manhattan house increased 62% in a run-up of the 1929 stock market crash, and then lost 51% of the value by the end of 33. So, I mean, there you go. When people are predicting that property's going to, shoot, it'll be slightly off and then up again. Let's look at those numbers. I've played here with some Excel. So say you've got a $500,000 house, and then you lose 50%. So you lost 250 grand. So the new value of your house is just 250,000. But then you're up 50%. You know, you've made a whole 125,000. So your new value is 375, which is still only 75% of what you originally had. So you're still down 25%, guys. But say, okay, well, no, what if I made 80%? Oh, you're still down 10%. What if I made 90%? Oh, you're still down 5%. What if I made 100%? There you go. Then you made your money back. This is the thing, guys. When you make a loss, a big loss, it can take a long time for it to recover. So people are predicting, you know, huge booms after this decline. And I mean, let's say if we take a 20% cut. Then, okay, so your house is now worth 400 grand. So then, you know, if you make, what do you make? If you make a 50% cut, you're only up 20%, 50% profit. Takes a while to make that. If you go up 30%, okay, you're still up 4%. If you go up another 20%, you're still down from where you were. So you've got to keep that in mind, guys. The more drastic it is, the longer the climb back up is. They don't seem to say that. Because, I mean, here we go. A 62% run-up in the stock market, a 62% increase, almost like what we've seen in property prices here in Australia. If we look here at the index, capital city, from 0 up to 120. Perhaps our property is booming a little bit. It's something to consider. So back to this article. By 32-37, the stock market showed signs of rebounding, but real estate did not, according to Sherbiner. A house purchased in 1920 would have lost 51% of its value in inflation-adjusted terms by the end of 39. Sherbiner and Nicholas report that it wasn't until 1960 that housing prices recovered. The upshot for today, according to Sherbiner, is that owning a house is not necessarily a lucrative long-term investment based on long-term exchange value. She explains that given maintenance costs and fluctuations in the real estate market, it is difficult to profit financially. She contends investors will be better investing in stocks and bonds because they can spread wealth across diverse investments and have the flexibility to sell some assets when necessary. Homeowners, on the other hand, can't sell some of their house when the economy shrinks, yet families do not value or think of their home simply as a long-term investment. So, I mean, there's some interesting insight to it. We've got another chart here I'd like to show everyone. Now, this is the history of home values. So this is the thing, it's inflation adjusted. And this is just from the 2006 boom, guys. Remember, Australia we didn't really get this pullback. So Yale economist Robert J. Schiller created an index of American house prices going back to 1890. It is based on sale prices of standard existing homes, not new constructions, to track the value of housing as an investment over time. It presents house values in consistent terms over 116 years, factoring out the effects of inflation. Now here's the thing. So the 1890 benchmark is 100 on the chart. If a standard house sold in 1890 for 100,000, inflation adjusted to today's dollars, an equivalent standard house would have sold for 66,000 in 1920, 66 on the index scale, and 1990 and 1,990 in 2006, 199 on the index scale, or 99% higher than 1890. So you can see here during the Great Depression. So we're getting mixed messages here with regards to this one here. I mean, okay, you had a housing boom before the Great Depression, and we're kind of seeing that probably here, right here, shooting up, and then going down. Okay, so we can see that housing boom here, and then going down over time, and then slowly creeping up again in the Great Depression. But they didn't reach the same value until the 1960s, according to this data. So I'm skeptical of predictions of a boom. If anything, I'm concerned that we're going to see more and more inflation with just money pumping out. So maybe our houses will have the same value, or maybe they will go up, but the purchasing power of that money may decrease. So guys, once again, Let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and you want to support us, there are a few ways you can. You can join the channel on YouTube or on Patreon. You can support us using our affiliate links at Amazon or eBay, or Independent Reserve and Kucoin. You can send us gold using Gold Pass, buy our merch at HeiseSays or Teesprings, or you can also use PayPal. Thanks everyone, have a great day, and I'll talk to you later. Bye for now.